In present video, I am going to explain about the balance sheet of a sole proprietorship. Before knowing about balance sheet, you should know about assets and liabilities. First, we will see about assets. What do you mean by asset? Properties which belong to the firm. If any property is owned by a firm, to that firm, that property is called an asset. Now, assets are of 5 types. Fixed assets. Fixed assets are again divided into 2 types. Tangible fixed asset, intangible fixed asset. Now, second one is current asset. Then third one, fictitious asset, wasting asset, contingent asset. Now, one by one, we will learn about all these assets. So, the first asset is fixed asset. To call any asset as a fixed asset, that asset should possess some features. What are they? First point is, they are used to carry on the business. Take one example. Suppose one firm is manufacturing these pens. To manufacture this pen, they need one machine. So they purchased one machinery. Now by using that machinery, these pens are manufactured. Now that machine is used to carry on the business now. Without that machine, you cannot manufacture this pen. Means what? Fixed asset is not meant for resale purpose. It is meant for usage purpose. In this example, pen comes under good. Good means what? If any article is meant for resale purpose, it is known as good. The intention of manufacturing this pen is to sell this pen to customer. But the intention of purchasing this machine is not to sell. We sell that machine. When we will sell? When machine is totally damaged, then only we are going to sell it. Now the second feature is they are used for a long period. Take the same example. Firm purchased a machine to manufacture this pen now. That machine is used for more than 1 year period. Therefore, fixed assets have a long life. Machinery, furniture, land, vehicles, all these fixed assets we use for a long period. They give long-term benefit to the firm. Then the third feature is depreciation is provided on fixed assets. What is meant by depreciation? When we use any fixed asset continuously, then that fixed asset value slowly decreases now. That decreased amount is called depreciation. Except land, on all other types of fixed assets like furniture, machinery, vehicles, etc., we provide depreciation. Why we should not provide depreciation on land? Because if any fixed asset has a certain life, then only on that asset we have to provide the depreciation. Means what? Suppose we purchase a machine. We can estimate the life of this machine. Say for 10 years we can use this. We purchased furniture. We can estimate the life of this furniture. But can you estimate the life of a land? Can you tell for how many years we can use a particular land? No. So the life of land is uncertain. It is infinitive. Therefore, on land we should not provide depreciation. The next feature is fixed asset cannot be converted into cash in a short period. For example, take this pen. For a firm which is engaged in manufacturing and selling these pens come under goods, no? So goods are meant for resale purpose. So when we manufacture this pen within a short period, nothing but within 1 year period, we sell it and we make money on this product. Means what? Goods can be converted into cash within a short period. If any asset can be converted into cash in a short period, then we can say that that asset is having liquidity quality. So liquidity means what? The possibility of converting that property into the form of cash. And if you take fixed assets, the liquidity of a fixed asset is less. For example, we have some land. Today morning I have decided to sell this land. Can I sell this land within 1 day, within 2 days, within 1 week? No. The last feature is fixed asset is valued at cost price. In accounts, we follow some concepts, no? There is one concept known as cost concept. What that concept says, while evaluating the fixed assets, its cost price should be shown in the books, not the market price. What is the meaning of this? I will explain with one example. Suppose a firm which is following calendar year, that is 1st January to 31st December as their accounting year, they purchased one asset, that is machinery, on 1st January 2015 for 10,000 rupees. So this 10,000 rupee is known as cost price, no? So how much they paid to acquire that property is known as cost price. And from 1st January to 31st December 2015, when they use this machine, then machinery value will get reduced. Assume that in that year 1000 value is reduced. Then this 1000 is known as depreciation. No? Now for 2015 year, when you prepare final accounts, then in profit and loss account, which we prepare on 31st December 2015, this depreciation on debit side we have to show. So to depreciation 1000 rupees, and on the same day we prepare balance sheet also. In balance sheet, asset side, while showing the machinery value, we follow cost concept. That is, we take the cost price of the asset in inner column, we deduct depreciation of that particular year from this cost price 1000, and in outer column we show the remaining value 9,000 rupees. If you observe, I am considering the cost price of the product. If there is any depreciation, then that depreciation I am deducting from the cost price, and remaining value I am showing in the outer column. Assume that on this particular day, the market price of this asset is 12,000 rupees. So I am not going to consider this 12,000, only cost price I should consider. Suppose market price is less than the cost price. Market price is assumed 7,000. Even in this case also, fixed asset is to be shown at cost price, not at market price. You may get one doubt. In case of fixed assets, why we have to follow cost concept? The reason is, the purpose of purchasing fixed asset is to use that in our business. It is meant for running the business. It is not meant for resale purpose. So as we are going to use this machine in next year also, we need not to know the market price of this machine. Assume that in 2020 year, this firm is going to be liquidated. So 2020 year is the last year for this particular firm. Then what they do? They are going to sell their business to others. In that case, they should know the market values of these fixed assets. Then in that particular year, we don't follow cost concept to evaluate fixed assets. We show the asset values at market price, because we should know the value of our business, the value of our assets. Fixed asset is of two types: tangible fixed asset, intangible fixed asset. Then what do you mean by tangible fixed asset? If any fixed asset is having some physical identity, then that fixed asset comes under this group. Tangible means what? Touchable. So we can touch that asset, we can see that asset. And when we take loan from a creditor, then as a surety, creditors accept these tangible fixed assets. What are the examples for tangible fixed assets? First one is plant and machinery. What is machinery? You know, to manufacture a product, the asset which we use is known as machinery. Then plant means what? Factory building. Then furniture, tables, chairs, almirahs, etc. come under this category. Then fixtures and fittings. Fixtures means what? Any electronic equipment like bulbs, fans, etc. come under this category. Then fittings means what? These are the accessories which are attached to the fixed asset. For example, we purchased one machine and we attached one handle to this machine. Now there is a handle comes under fittings. Next one is buildings. Then land. Then premises. Premises means what? Land or any building which is owned by the firm. It may be a factory building, office building, showroom building, godown building, including the walled or fenced space surrounding it. Next, vehicles, long-term investments. Long-term investment means what? We have some savings money. With that money, we purchase other company debentures or equity shares. So after 1 year, we are going to get back our principal amount. So that type of investment is known as long-term investment. Then next come to second type of fixed asset, that is intangible fixed asset. Intangible fixed assets are not having any physical existence. We cannot touch them, we cannot see them, and creditors don't accept these assets as a security while giving loan to the firm. What are the examples for intangible assets? Goodwill. What is meant by goodwill? For example, we are running one sole trading organization and we want to purchase another reputed firm. So their assets total is 40 lakh rupees and their liabilities total is 5 lakh rupees. So when we purchase their business, then we will become the owner of their assets. Similarly, we are liable to pay this 5 lakh rupees to creditors. So their assets and liabilities will become our assets and liabilities. So we have to pay some amount to them. The amount which is paid by purchasing firm is known as purchase consideration. Actually speaking, how much we have to pay to them? Asset total 40 lakh minus liability total 5 lakh, 35 lakh we have to pay to them. Because 35 lakh worth property finally we are going to get from them. But we paid 50 lakh rupees as purchase consideration. So how much extra we paid? 50 lakh minus 35 lakh, 15 lakh rupees we paid. Why we paid that 50 lakh rupees extra? Because not only their assets and liabilities, their brand value also we are going to get in future. So this is one reputed firm. So their reputation we are going to enjoy in future. So towards that reputation we have to pay some extra amount which is known as goodwill. So how to calculate this goodwill amount? For that there are different methods. Average profit method, weighted average profit method, super profit method, capitalization method. There is a separate lesson for this goodwill valuation. By using one appropriate method, goodwill amount will be calculated. So the amount which we paid to them in the form of goodwill appears in our balance sheet asset side. Now the second example is patents. Patents means what? For example, we are running one pharmaceutical industry and one scientist innovated one medicine. To manufacture that medicine, some chemicals in a particular ratio we have to mix. No. There will be some formula to manufacture that medicine, and we want to manufacture that medicine. So what we supposed to do? We have to purchase patent rights from that particular scientist. We registered that formula with government. Our firm is only having the right to use that formula. Others should not use it. Generally, patent rights will be taken for a period of 20 years. So you cannot see patent right now. It is not visible to you. So it comes under intangible asset. Now the next asset is copyrights. For example, we are the publishers of books and one author wrote one book. We want to purchase the publishing rights from that particular author. Then what we do? We register that publishing rights with the government. So others should not publish this content. We are only having the right to publish that matter. This right is called copyright. The next one is trademark. Trademark is also known as logo or emblem. Trademark contains symbols or company names or brand name or any caption. For example, see this symbol. So this is a trademark of State Bank of India. So this symbol represents one meaning. That is, you deposit your money in our bank, then we will put it in our locker and we will lock it. This is lock symbol, no? So this symbol only SBI can use. Other banks should not use this symbol because this symbol is registered by SBI with the government. You may get one doubt. We can see this symbol now. So you are telling that intangible assets means invisible. But you can see this. The symbol we can see. But trademark doesn't mean that symbol. Trademark means what? The right to use that particular symbol. That right you cannot see. So trademark also comes under intangible asset. Remember one point. Intangible fixed assets are not depreciated. They are amortized. Next come to current assets. Current asset is also known as floating asset or circulating asset. Let us see the features of current asset. First feature is they are meant for resale or consumption. For example, a trading concern purchased finished product from wholesale market. This product comes under good, also known as inventory, stock. It is meant for resale purpose now. So the current asset is used for resale purpose, or current asset may be used for consumption purpose. For example, we are running one manufacturing concern. Then we purchase raw material. This raw material comes under current asset and we consume that asset while manufacturing the finished product. Therefore, if any asset is meant for resale purpose or for consumption purpose, that asset comes under current asset. Then second one is current asset is used for a short period. For example, if we are running one stationery shop, what are the goods to us? Stationery items. How long we keep these goods with us? For a short period only. So within 1 year, we are going to sell these goods to customers. But in same stationery shop, owner is using chair, owner is using fan, they come under fixed assets. Will he sell them in a short period? No. When chair is totally damaged, then only he sells it. Take another example. Suppose we have some cash balance in the firm. Do we keep that cash as it is for 20 years period? No. So within a short period, we are going to use that amount. As current asset is used only for a short period, current asset is also known as circulating asset. What is meant by circulating? Moving. In a short period, it moves from us. So current asset is also known as circulating asset. The next feature is current asset value fluctuates. If you take any fixed asset value, the value of a fixed asset will get reduced slowly. But in case of current asset, the value will not reduce, will not increase, the value will fluctuate. Fluctuating means what? Up and downs. For example, cash in hand comes under one current asset. In our firm, today cash balance is 50,000. Tomorrow it may be 60,000. Day after tomorrow it may be 10,000. So what happened to current asset value? It is fluctuating. Next feature is current assets have liquidity quality. Current assets are known as liquid assets. Liquidity means what? If any asset is converted in the form of cash within a short period, then we can say that that asset is a liquid asset. For example, we have goods with us. Within a short period, we sell these goods and we will make money. Another example is debtors. Debtor means who? A person who is liable to us. So the maximum credit period allowed to a debtor is 3 months. And within 3 months, from that particular debtor, we will get the money. Means that debtor will be converted into cash form. Thus, all current assets we can convert into cash form within a short period. So current assets are having liquidity quality. Then next one, we should not provide any depreciation on current assets. When we provide depreciation, if any asset is used for a long period, then according to going concern concept, according to matching concept, we have to provide depreciation. But current assets are used for a short period, so we should not provide any depreciation on them. Then next feature is current assets are valued at a cost price or market price, nothing but net realizable value, whichever is lower. Means what? Take closing stock. In final accounts, where we show closing stock? In trading account, credit side, and in balance sheet, asset side. This is trading account, credit side by closing stock. In balance sheet, asset side, we show closing stock value. When we prepare final accounts at the end of the year, if firm is following calendar year on 31st December, for example 15 year, on this date we are evaluating closing stock. While showing the closing stock value in the books, we have to follow conservatism convention. Conservatism is also known as prudence. What the convention says? Cost price or market price, whichever is less, that price is to be shown in the books as the value of current asset. For example, closing stock, cost price is 10,000 rupees and market price on 31st December 2015 is 8,000 rupees. Then which price we should show in the books? 8,000 is less, so 8,000 we have to show here. Suppose market price is 12,000 rupees. In that case, closing stock value should be 10,000 rupees only, not 12,000. Why current asset is known as floating asset? Because within a short period, it will change its form. For example, we have some cash in our firm. Cash is 10,000 rupees. Current asset is in the form of cash in hand. Assume with this 10,000 rupees we purchased goods. Then what happened? In the place of cash, now goods are there. So cash is converted into goods. Similarly, we sold goods to a customer on credit. Then that customer becomes a debtor. Debtor comes under current asset. Say value is 8,000 rupees. So current asset is in the form of a debtor. And If we want to have a written proof from him, then we prepare a bills of exchange, we take his acceptance. Then what happens? Debtor current asset will be converted into bills receivable asset. Assume that he paid money on the due date. Now bills receivable will be converted into cash form. So within a short period, current asset will change its form. Therefore, this asset is called floating asset. Now see the examples for current assets. First one is cash in hand. Means what? In firm, the cash balance which we have is known as cash in hand. Always we keep some ready cash to meet day-to-day expenses. Now that balance comes under cash in hand. Then second one is cash at bank. Assume our firm is maintaining one bank account. In that account we have 5,000 rupees bank balance. That favorable bank balance is called cash at bank. It is a current asset. Next one, stock. So at the end of the year, the unsold goods left over with us are known as closing stock or inventory. So we represent it with stock. So the closing stock of current year will become opening stock for next year. The next one, bills receivables. Means what? Bills receivable means it is a written proof which is taken from a debtor. With one example, I will explain this point. Suppose on 1st January 2018, firm sold 1 lakh worth goods to a customer known as Ravi. If we sell these goods to him for cash, there is no question of generating a bills receivable. Assume that we sold these goods to him on credit basis and we have given 2 months time to him. So when he is supposed to pay the amount? 1st February 1 month, 1st March 2 months. So on 1st March 2018, Ravi has to pay 1 lakh rupees to us. If Ravi is familiar person to us, then no need to take any written proof from him. But assume that he is a stranger to us or we have some doubt on Ravi. In that case, for this credit transaction, we want one written proof. Then what we do? On 1st January 2018, firm prepares a bills of exchange on Ravi. So in this document, firm mentions complete information about this transaction. So on 1st January 2018, so and so firm is selling 1 lakh worth of goods to Ravi, and Ravi has to pay this amount after 2 months, that is on a particular date. Instead of first date, why I wrote 4th date? Because in case of bills of exchange, extra 3 days will be added. So from 2nd date, if you count 2nd, 3rd, 4th March 2018 is called due date. Okay. On that day, Ravi has to pay 1 lakh rupees to us. We mentioned like that. We affix one revenue stamp, firm's stamp, our owner's signature. Then we present this document to him. Now Ravi goes through with this information and he has to accept this bills of exchange by writing accepted word. Okay. And Ravi puts his signature. Now this document is known as bills of exchange. It comes under negotiable instrument. This can be transferred to other person. Now from our point of view, on this particular document in future, we are going to receive amount now. So to the firm, this document is known as bills receivables. As we are going to receive money on this document, this is one asset to us. In balance sheet, on asset side, we have to show bills receivables. After 2 months, if Ravi fails to pay that amount, Then if we want to take legal action on him, then these bills of exchange acts as a written proof to us. Next current asset is short-term investments. For example, with our savings money, we purchased money market instruments. We purchased treasury bills. We purchased commercial papers. They come under short-term investments. So within 1 year, we will get back our principal amount. Then debtors, also known as sundry debtors, means what? Debtor means what? For example, on 1st January 2018, firm sold 1 lakh worth goods to Ravi. We may sell for cash or on credit basis. Assume that to Ravi we sold these goods on credit basis, and Ravi requested to give 2 months time to him. So till 2 months, Ravi becomes a debtor. So debtor means who? A person who has taken the benefit from us and in return not yet paid any amount to us. So a person who is liable to us is known as debtor. So debtor is an asset. Clear? In balance sheet, on asset side we have to show this amount. And sometimes in trial balance, instead of debtor word, he may give sundry debtor word. Then what is mean by sundry debtors? Sundry means various. So generally what happens is, in ledger book, on each debtor name, we open a separate account. For example, Ravi is a debtor. So Ravi account we open. Murali is a debtor. Murali account. Sonu is a debtor. Sonu account. When we open a separate account for one debtor, if between that debtor and us, the number of transactions are more. But to one debtor, for example, Raju, in 1 year, only 2 times we sold goods on credit basis. Then only for 2 transactions, opening a separate account in ledger is not advisable. So when number of accounts increase, then chances of mistakes also increase. Then what we do, instead of opening Raju account, we open sundry debtors account. In that account, we record Raju related credit sale transactions. Next one is loose tools. Loose tools means what? These are the assets which are used in production process. For example, screws, tapes. We use them for a short period and it is very difficult to maintain a separate account for each account. Can we prepare screws account or tapes account? No. So all these type of assets which are useful to manufacture a product, they are named as loose tools. Next come to fictitious assets. Next one is fictitious asset. It is also known as nominal asset or imaginal asset. What is meant by fictitious asset? With one example I will explain. Suppose a firm spends 60,000 rupees to 80,000 rupees per annum towards advertisement expenditure. So this advertisement expenditure is regular advertisement expenditure to them. It comes under revenue expenditure. And assume that in 2015 year, that firm is going to launch a new product. Since customers are not aware of this product, to create a brand value, to bring that product familiar to customers, firm spent heavy advertisement expenditure in 2015. Amount is 3 lakh rupees. Amount is spent in 2015, but since it is a heavy advertisement expenditure, Firm is expecting that from this heavy advertisement expenditure, firm is going to earn the income in 2015, 16 and 17. So expenditure we incurred in 1 year, but the benefit from that expenditure is for 3 years. According to matching concept, if income is for 3 years, to earn this income, if any expenditure is incurred, that expenditure also we have to show for this 3 years. So 3 lakh rupees divided by 3 years is equal 1 lakh rupees. Then in 2015 year final accounts, 1 lakh will be debited to profit and loss account as advertisement, and from 3 lakh rupee, when 1 lakh rupee is written off, then the remaining amount 2 lakh rupee appears on asset side of balance sheet as advertisement expenditure. Now this 2 lakh rupee advertisement expenditure which we are showing on asset side of balance sheet, it is called fictitious asset. So it has no realizable value. See the feature of fictitious asset, no realizable value. Means what? Suppose machinery we have written in balance sheet asset side. So this machinery is having some resellable value. You can sell it, you can make money. Furniture is having some resellable value. Building we can sell and we can make money. But can we sell this 2 lakh rupee advertisement expenditure to anybody? No. So it is not having any realizable value. That is why this asset is known as nominal value. Means only for namesake we are showing that on asset side. Really it is not an asset. This asset is also known as imaginal asset, because actually it is not an asset even though we are writing on asset side. So it is an imaginary asset to us. Similarly, if you prepare final accounts of 2016 year, then what we do? Out of 3 lakh rupee, 1 lakh rupee we have written off in 2015 year by debiting to P&L account. Now another 1 lakh rupee we will write off in 2016 year P&L account. Now in balance sheet, how much is the value of this fictitious asset? 2 lakh rupee minus the amount which we have written off in 2016, 1 lakh. Then the remaining value 1 lakh comes under advertisement expenditure. It is a fictitious asset. And for 2017 when you are preparing final accounts, that last 1 lakh rupee is also written off by debiting to P&L account, and in 2017 year balance sheet there is no advertisement expenditure because total 3 lakh rupee is written off now. So for 2017 there is no fictitious asset. Now what is the second feature of fictitious asset? It is an intangible asset. Can you see this advertisement expenditure? No. So it is not having any physical existence. See. Now what are the other examples for fictitious assets? Let us see. Examples are heavy advertisement expenses, preliminary expenses, discount on issue of shares and debentures, profit and loss account, debit balance. Next asset is wasting asset. What do you mean by wasting asset? With every dig or with every extraction, if asset is exhausted, if asset is depleted, then that asset is called wasting asset. With one example I will explain. There is one firm. This firm purchased a coal mine. See, this is the surface of the earth, and beneath the earth coal is there in one particular mine. When they purchased this mine in 2011 year by paying 50 lakh rupees. So the cost price of this coal mine asset is 50 lakh rupees. And in 2011 assume that they have extracted some coal. Then at the end of the year, the mine value will not remain same 50 lakh rupee. Assume that in 2011 they extracted 5 lakh worth coal. Now in balance sheet, the mine value will be 45 lakh rupees only. So what happened here? With every dig, mine value is going to reduce. If you dig that mine every year in this manner, then on a particular date, the mine will become empty. So mine become depleted. Mine become exhausted. Exhausting means what? Completing. So this coal mine comes under wasting asset. What are the other examples? Quarries, timberlands, oil reserves, they come under this category. In case of wasting assets, we should not use a depreciation word. So wasting assets are not depreciated, they are depleted. So depletion is the appropriate word for wasting assets. Now the next one is contingent asset. Contingent asset. What do you mean by contingent word? Uncertainty. So according to Accounting Standard 29, contingent asset means it is a possible asset whose existence will be confirmed only after occurrence or non-occurrence of uncertain future events not wholly within the control of the firm. To understand this sentence, you should know one example for contingent asset. Example is a claim that a firm is pursuing through legal process. What is the meaning of this sentence? See, I am running one organization. I have one litigated land. Means regarding the ownership on that particular land, court case is going on. Now the judgment is not in my hand. If judgment comes in favor of me, then I will become the owner of that particular land. For me, that land becomes an asset. If judgment is against me, then I am not the owner of that land. So observe this sentence now, you will easily understand. Contingent asset is a possible asset. There is a possibility of becoming the owner of that particular asset. Now we are not the owner of that asset. Possibility is there. Asset whose existence, that possibility will be confirmed only after occurrence or non-occurrence of uncertain future event. Future event is what? Judgment given by the court. That judgment is uncertain. Today I cannot predict whether that judgment comes in favor of me or not. I cannot predict. So judgment is uncertain, and the occurrence of this judgment means what? Judgment in favor of me, or non-occurrence of that judgment means what? Judgment against me. So whether the judgment comes in favor of me or against me, regarding that there is some uncertainty. Clear? Not wholly within the control of the firm, and there is a future event, judgment given by the court is not in our control. No, we cannot influence the judge who is going to give that judgment. So what do you mean by contingent asset? There is a possibility of becoming the owner of a particular asset in future. Possibility is there. Today we don't know whether we are going to become the owner of that asset or not. That is called contingent asset, uncertain asset. Now, while writing the contingent asset in the books, nothing but while disclosing the contingent asset in the books, we have to follow conservatism convention. What this convention says? Record all expected future losses in the books, but don't record expected profits in the books. So if we become the owner of that particular land, then it is one profit to us. Today we don't know whether that profit will come or not. So for today, that profit is an expected profit. So we should not record that in the financial statements. Means all other assets you are writing on the asset side of the balance sheet now, but contingent asset we should not show in the balance sheet asset side. So where we have to disclose this contingent asset? Report of the approving authority. Means what? For example, take one joint stock company. So in case of company, the approving authority is board of directors. So every year, board of directors prepare annual report of that company. In that report, they are going to mention about this contingent asset. If it is not a company, if it is other form of organizations, in appropriate reports, they have to mention about this contingent asset. With this, assets topic is completed. Now next topic is liabilities. Liability means what? Financial obligations of the firm are known as liabilities. Obligation means what? Responsibility. Financial means what? Money related. So the meaning of this sentence is, if firm has to pay any amounts to others, then to the firm that responsibility is known as liability. Nothing but if firm owes to others, it is called liability. Now liabilities are divided on the basis of source, on the basis of time, and other type of liability is also there, that is contingent liability. So based on the source of liability means from whom we are taking that loan, based on that factor, liability is divided into two types, internal source and external source. What do you mean by internal liability? Internal liabilities are the liabilities where firm owes to its proprietor. Proprietor means who? Owner. To owner, if firm is liable, then that liability is known as internal liability. Take one example. There is one firm and Gopi is the owner of this firm. To start the firm, Gopi brought some capital. Amount is 5 lakh rupees. Here an accountant of this firm. While showing this 5 lakh rupees amount in the books, you have to follow one concept, that is business entity concept. What that concept says? While recording the values in the books, show a discrimination between firm and owner. In other words, treat owner as an outsider. So from one outsider, when we take money, we think that we are taking loan from him. So here also same concept you have to apply. So you have to think that owner is one outsider. From him we are taking 5 lakh rupees loan. So this loan amount is known as capital. That is why capital appears on the liability side of the balance sheet. So example for internal liability is capital. Now come to next type of liability, that is external liability. Means what? Firm owes to third parties. These are the liabilities which are owed to third parties. First party is firm, second party is owner. To owner, if we are liable, then it comes under internal liability now. If firm is liable to third parties, outsiders other than owner, then that liability comes under external liability. Example, creditors, also known as sundry creditors. Means what? Creditors, sundry creditors. What do you mean by creditor? To any person, if firm is liable, then that person is called creditor. Take one example. On 1st January 2018, firm purchased raw material worth 50,000 rupees from Kiran. We purchase goods for cash or on credit basis. Assume that from Kiran we purchased these goods on credit basis and we requested to allow 1 month credit period. He accepted. Now for this 1 month period, Kiran becomes a creditor. So creditor means who? A person to whom we are liable. So we have taken benefit from him and in return we are not yet paid money to him. That person comes under creditor. Creditor is a liability. So in balance sheet on liability side we have to show this amount. Sometimes in trial balance, instead of creditor's word, he may give sundry creditor's word. When he uses sundry creditor word, let us see. You know sundry means what? Various. For example, Kiran is a regular supplier to us. Gopi is a regular supplier to us. Ravi is a regular supplier to us. Regularly, we buy goods from them on credit basis. In that case, in our ledger book, we open Kiran account, Gopi account, Ravi account. Because so many transactions will be there. So opening a separate account is good. But assume that from Murali, in 1 year, only one time we purchase goods on credit. From Suresh, only 2 times we purchase goods on credit. So these 2 suppliers are rare suppliers to us. Then why to allot a separate account for them? So instead of doing like that, what we do? We record this type of transactions under sundry creditors head. Next one, bills payable. Means what? It is a written proof which is prepared by one creditor on us. Let us take one example. On 1st March 2018, firm purchased raw material worth 50,000 rupees from Gopi. So Gopi is a supplier to us. We may purchase these goods for cash or on credit basis. Assume that we purchased these goods on credit and we requested 1 month time. Gopi allowed 1 month time to us. If Gopi wants a written proof from us, then Gopi prepares bills of exchange, stating the complete information about this transaction. He mentions that on 1st March 2018, Gopi is selling 50,000 worth of goods to so and so firm. And this firm has to pay the money after 1 month period. Then Gopi's signature, he affixes one revenue stamp and he presents this document to us. We will go through with that information and we have to accept this document by writing accepted word and by putting our signature. Now on this document, in future, firm has to pay the money, no? It is one obligation to us. Then that obligation comes under bills payable. So bills payable is a liability. So in balance sheet on liability side, we have to show this amount. Next one, bank overdraft. So we have one bank account how much balance we have in that account, more than that we withdrew. It is known as bank overdraft. Here firm is liable to banker. Debentures means what? Firm took loan from the public. Then to public, firm issued one acknowledgement. That document is known as debenture. Debenture comes under external liability because from public we are taking that loan. Next one is loans taken from banks or from any other financial institutions like IDBI, IFCI, UTI, etc. Then outstanding expenses. Say to one's employee we have to pay salary. It is called outstanding salary. To whom we are liable? To employee. Employee is third party only, no? Then income received in advance. When we have to receive income after giving the service, if we receive the income, that is not a liability. But assume that we have not given any service to other party, but we received income from him in advance. Then the meaning is we are liable to that third party. In future we have to give service to them, so we are becoming liable to them. That liability comes under external liability. Now the next base is time. Based on for how long you are taking the liability. Liability is divided into two types, fixed liability and current liability. Let us see about them. Fixed liabilities, also known as long-term liability, means what? This liability is repayable after a long period. Long period means more than 1 year period. Examples are capital. From owner, firm took capital. When firm is going to repay that capital? Only at the time of liquidation. So it is a long-term capital. Similarly, long-term loans taken from banks or any other financial institutions. If firm takes loan for 7 years period, 10 years period, that loan comes under this category. Next, debentures. Generally, firm issues debentures to public for more than 1 year period. Say firm issued it for 10 years period. So after 10 years only firm has to pay the principal amount to creditors. Now debentures also come under fixed liability. The next type is current liability, also known as short-term liability. Means what? If any liability is repayable in the near future, nothing but within 1 year, if we have to repay the loan which we have taken, that liability comes under current liability. Examples: creditors or sundry creditors, bills payable, bank overdraft, outstanding expenses, income received in advance. Now next one is contingent liability. What is meant by contingent liability? According to Accounting Standard 29, a contingent liability is a possible obligation, the existence of which will be confirmed only by the occurrence or non-occurrence of uncertain future event not wholly within the control of the firm. I will explain the meaning of this sentence with one example. See, examples I wrote here. Third example I am taking, liability in respect of bills discounted. Suppose we are running a firm. On 1st January 18, we sold goods to Prabhu on credit. Goods value is 1 lakh rupees. Then Prabhu requested 2 months credit period. So when Prabhu is going to pay the money? After 2 months, that is 1st January 18 to 1st February 18, 1 month. 1st March 18, 2 months. On that particular day, when we want a written proof from Prabhu, what we do? We prepare a bills of exchange. on Prabhu on this particular date. We take acceptance from him. Now we keep these bills of exchange with us. As we are going to receive money on this bill in future, to us this is bills receivable and asset. When we are going to get the money on this bill, to this date we have to add extra 3 days in case of bills of exchange. So 2nd March, 3rd March, 4th March. So due date is 4th March 18. But assume that before this date, for example, on 1st February 18 only, firm need this bill amount. Can we ask to Prabhu? No. Because to Prabhu already we have given 2 months time. He is not in a position to honor the bill on this particular date. Then what is the other option? We can sell this bill to our banker. So selling the bill to bank before the due date of the bill is known as discounting the bill. Now this bill is not with us. What we did? We sold this bill to bank on this date. So we submit this bills of exchange document to them and they pay bill amount to us. Don't think that they pay full amount. They deduct some amount towards discount. Bill value is 1 lakh rupees now. Assume they deducted 2000 rupees. Then how much money they paid to firm? 1 lakh minus 2000, 98,000 rupees. Now bill is with whom? With the bank. On the due date, bank went to Prabhu. Bank presented this bill and assume that Prabhu honored the bill. Means what? Prabhu paid bill amount 1 lakh rupees to bank. Then we are not liable to banker because bill is honored. Assume that on that particular day, Prabhu failed to honor the bill. Prabhu didn't pay the money. Then who is the second responsible person? Firm. Then bank demands that amount from firm only. Now we become liable to bankers. From 1st February 18 to 4th March 18, we don't know whether bill will get honored or dishonored. So for us, for this particular period, this bill is called a contingent liability. Contingency means what? Uncertainty. Now observe the sentence, you will understand. A possible obligation. Obligation means what? Responsibility, liability. That responsibility may be a possible responsibility. Means what? We may become liable to bank or we may not become liable to bank. So there is a possibility of becoming liable to bank when bill is dishonored by Prabhu, when Prabhu fails to pay the bill amount. Possible obligation, the existence of which will be confirmed only by the occurrence or non-occurrence of uncertain future event. What is the future event here? Honoring the bill. On the due date, Prabhu has to pay the bill amount. That is the future event. That future event is uncertain. Why? Because it may occur, it may not occur. Prabhu may honor the bill or Prabhu may dishonor the bill. See the continuation. Not wholly within the control of the firm. Now, honor or dishonor of this bill is purely dependent on Prabhu. So, if financial status is good, he honors the bill. Otherwise, he dishonors. Means what? The honor or dishonor of the bill is not in our hands. So, to us, this liability is known as a contingent liability. So, we may have to pay the loan amount in future. Whether we are liable to pay that amount or not, we cannot guess now. It depends on the future uncertain event. then that liability is known as contingent liability. See the other examples. Claims against the firm not acknowledged as a debt. What is the meaning of that? One customer filed a case against us. He used our product. He is thinking that due to the substantial quality of that product, he suffered a loss. He filed a case in court. If judgment comes in favor of that customer, then firm has to pay the compensation. Today it is one expected liability to me. If judgment comes against to customer, then I need not to pay compensation to customer. It is not a liability to me. So today the chances are 50-50 now. It is called a contingent liability. Next example, guarantees given in respect of third parties. For example, Gopi is my friend. I am running a business. Gopi took bank loan and I have given guarantee for that loan. If on the due date Gopi repays that loan amount, I am not liable for that amount. If Gopi fails to repay the money to banker, then I will become liable for this amount. So the chances are uncertain. Okay? It is also known as a contingent liability. And according to Accounting Standard 29, how to disclose contingent liability in the books? There is a difference between other liabilities and contingent liability. These are confirmed liabilities. We know that compulsory on a particular date we have to pay that. But here there is a doubt now. We may have to pay or we need not to pay. When there is a doubt, you cannot show that amount in balance sheet amount column. So as a footnote you have to mention. See here in balance sheet by the way of footnote. Footnote means what? In balance sheet all ordinary liabilities amounts you can write in outer column, main amount column. But if it is a contingent liability, in balance sheet on liability side show that particulars, but amount you should not write in main amount column. Where you have to show that amount? In inner column. Means what? While totaling the liabilities, are you considering contingent liability? No. We can do in another manner also. Instead of showing in balance sheet inner column, below the balance sheet you can mention so and so contingent liability we have. Why contingent liability we should mention in the books? Because in accounts we have one convention, that is a disclosure. What this convention says, when accountant prepares reports, each and every material fact related to business we should disclose in the books. Material fact means what? The transaction which is important to form an opinion about something. So based on that value, the bankers, the investors, government going to take some important decisions. Contingent liability is one material amount because it has some value. Therefore, we should record that in the books according to disclosure. But instead of recording it in the main liability column, where we record as a footnote, we record this amount. Now you came to know about the meaning and types of assets and liabilities. With this knowledge, now let us see how to prepare a balance sheet. For a trading concern, final accounts include 3 reports: trading account, profit and loss account, and balance sheet. So about trading account and profit and loss account, I made another video. That video link I am giving in the description box. To know the meaning of balance sheet, we should know about the asset and liability meanings and types. That part is completed. Now I am going to explain about balance sheet. This is the format of balance sheet. See the heading? Balance sheet of dash. What we have to write here? In question, he gives the sole proprietor's name or his shop name. That name we have to mention here. For example, proprietor name is Sachin. Then we have to write balance sheet of Sachin as on 31st December 2018. You know that balance sheet is a part of final accounts. Final accounts we prepare always at the end of the year. If end of the year is 31st December 2018, then what is the starting date of the year? 1st January 2018. So firm is following calendar year from 1st January to 31st December. So many transactions have taken place. The final result they want to know. So on 31st December 18 they are preparing final accounts. So balance sheet also they prepare on that particular day. And balance sheet is divided into two parts. Now left portion is known as liabilities and right portion is called assets. In liabilities we have to show internal and external liabilities. Nothing but fixed liabilities and current liabilities. On asset side we have to show various types of assets one by one. Fixed assets, current assets, fictitious assets, wasting assets we should show here. About all these assets and liabilities clearly I explained to you. Balance sheet is also known as position statement or statement showing the sources and application of capital. On a particular day, how much worth the assets we are having and how much worth the liabilities we have to pay to creditors. These two informations, if we show in one particular statement, that statement is called balance sheet. No? By seeing this balance sheet, we can know the financial position of this firm. That is why balance sheet is also known as position statement. And what is the other name for balance sheet? Statement showing the sources and application of capital. Sources means what? Suppose I am running business, I am preparing this balance sheet. To my firm, how money came, from which sources I received money, all these sources I should show under liabilities heading. Owner brought capital, in that form I got some money. Similarly, I have taken loan from bank, in that form some amount came to me. In the form of bills payable, I got some goods. In the form of creditors, I got some goods. Even general reserve amount also we show under liabilities. If it is a partnership business, if it is a company, on liability side we show general reserve. General reserve means what? Accumulated profit, nothing but retained earnings. Our savings money. Our savings money we need not to pay to anybody. Then why it appears in balance sheet liability side? Because the reason is liability means don't think that the amounts which we have to pay to outsiders, all those amounts only we are writing here. Actually what we are writing here, the sources of income we are writing. How money came into the business we are writing here. And asset means what? Application of this sources amount. How capital came, on left side we are showing, and how that capital is utilized on various assets we are showing on asset side. So from that capital amount, say we purchased 50,000 worth machinery. Machinery 50,000 we write. With this capital amount, we purchased 10,000 worth of furniture. So furniture we will write here. We purchase land, we purchase building, and finally how much amount is left over with us? That amount will be appeared in the form of cash in hand, cash at bank. That is why in balance sheet two side total should be same. Same meaning is given here. See, third point is a statement showing the sources and application of capital. Balance sheet means what? It is a statement which shows the sources, nothing but liabilities, and application, nothing but assets of capital. How capital money came, how we use that capital amount, we are showing in this statement. Okay. Now see the first meaning of balance sheet. A statement showing all assets and liabilities of a firm on a particular date. Balance sheet is a statement. First of all, this statement word, we will concentrate on this. In final accounts, we prepare three things now. First one is trading account. Second one is profit and loss account. Third one is balance sheet. If you observe, for first two reports, we are adding account word because these two come under accounts. But we are not adding any account symbol here. Means what? Balance sheet is not an account, it is only a statement. In case of trading account, profit and loss account, what happens is, in ledger book, we prepare all personal accounts, real accounts and nominal accounts now. For example, salary account we prepared in ledger book. Salary is an expenditure, so it is a nominal account. And in ledger, we prepared machinery account, asset account, so it is a real account. And we prepared loan from bank account, it comes under personal account. We prepared bills receivables account, it comes under personal accounts. If you carefully observe, salary, nominal account, no, this is, in case of nominal account, from 1st January 18 to 31st December 18, whenever we pay salary, we post in that salary account. Every month, we calculate balance carried down, and for next immediate month, we carry forward that balance. But at the end of the year, we close this nominal account by transferring the balance to either profit and loss account or to trading account. We show salary in P&L account now. That is why salary account we closed it by transferring to profit and loss account. Suppose wages account we are preparing. To which account we have to transfer? To trading account. At the end of the year, all nominal account balances we close by transferring them either to trading account or P&L account. For that, in journal proper book, we record some journal entries. Those entries are known as closing journal entries. For example, take trading account. Trading account debit side, what we write? To opening stock, to purchases, to wages, all these amounts. Don't think that directly we record all these values in trading account. To record like this, we have to pass one closing entry in journal proper book. What is the entry? Trading account debtor to opening stock, to purchases, to wages, to cartage, etc. Now that entry we are posting in trading account. Similarly, in trading account credit side we write sales. What is the entry for that? Sales account debtor to trading account. That closing entry we post in trading account. In case of profit and loss account also same. The amounts which we are debiting to profit and loss account, for that we write one closing entry. For credit amounts of P&L account also we write one closing entry. So trading account and P&L accounts are nothing but the end results of closing entries. One entry we write, that entry we post in trading account and P&L account. Therefore, these two reports we prepare in the form of accounts. That is why you recollect we used to write DR, CR symbols. Debit side whatever we write in trading account, with to we start. Credit side with by we start. Means what? all posting rules of a ledger account we follow while preparing trading and profit and loss account. As all nominal accounts are closed at the end of the year by transferring to trading or P&L, nominal accounts are known as temporary accounts. So the existence of a nominal account is restricted to only 1 year. From 1 year to next year, we never carry forward nominal accounts. But for real accounts, personal accounts, we don't close at the year end. Suppose take machinery. Whenever we purchase machine during this 2018 year, we post that in machinery account. Sales we post here. Depreciation we post here. And assume that on 31st December 2018, we are closing this machinery account. Then we don't transfer this balance to balance sheet. So what we have to write on 31st December 18? By balance carried down. You should not write by balance sheet. If you write by balance sheet, then the meaning is you are writing one entry, that is balance sheet account debtor to machinery account. Since machinery is in credit side by balance sheet we are writing. Then this entry will be posted in balance sheet account. But it is not correct. If you write by balance sheet word here, then what happened? Machinery account is closed at the year end by transferring to balance sheet. But same machine in next year also we will use. So for next year again you have to open the machinery account. So even though you close all real accounts and personal accounts by transferring the balance to balance sheet, next year again we have to open all these accounts. So why to close them? Why to open them? Unnecessary work. So what we do? We write by balance carried down. And for next year when you are preparing machinery account, what we do? On 1st January 19, this balance carried down directly we bring here. What to write? To balance brought down. In machinery account, on 31st December 18, balance carried down amount is assume 5,000 rupees. Now this 5,000 rupee, when you prepare balance sheet on 31st December 18, asset side we have to show machinery amount is 5,000 rupees. In case of a machinery, are we posting any entry in balance sheet? No. Only that balance carried down figure we are listing in the balance sheet. If we post in balance sheet is to be prepared in the form of account. Then two sides we have to mention debit and credit symbols. Similarly, whatever you write under liabilities, you have to start with TO2. On asset side, we have to start with by. But it is not correct. So, since balance sheet is a statement, don't write DR, CR symbols. You should not call it as debit side and credit side. Liability side and asset side. These are the correct words for balance sheet. So, balance sheet is only a statement. Statement means what? A report. Clear? On a particular date. Statement showing all assets and liabilities of a firm on a particular date. Observe the heading, balance sheet of Sachin as on 31st December 18. As on we wrote. You can write as at also. Once you recollect the headings of trading account and profit and loss account, we used to write trading account, profit and loss account of Sachin for the year ended. So, Trading account, P&L account amounts are what? They represent one particular period. But balance sheet values, they don't represent a particular period. They represent a particular date. Means what? When machinery value is 5,000 on 31st December 2018, then the meaning is on this particular date machinery value is 5,000. Next day anything may happen. Suppose firm purchased extra machine, then what happens to balance sheet values? It is not true for next immediate day. Firm purchased extra 10,000 worth of machine. Now the machinery value is 15,000 rupees. Say we purchased it for cash. Now cash amount which we show in balance sheet asset side, that amount also will get changed. And assume that we wrote closing stock value here 10,000 rupees. So on 31st December 18, closing stock value is 10,000 unsold stock goods. What happened? Next day we sold some goods. Then closing stock value will get changed. If we sell it for cash, cash amount also will here to change. If we sell on credit, then debtors amount will get changed. And if we sell it for profit or loss, then here on liability side, capital amount also will change. So the balance sheet values are true only for that particular date. So this balance sheet is not applicable for next date. Therefore, we should not write further year ended. We should write only as on. Then see the second meaning. First meaning of balance sheet and third meaning. These two I explained to you. Now come to second meaning of balance sheet. A statement which contains all the balances that are left over after the preparation of the trading account and profit and loss account. Means what? In trial balance, all these ledger account balance figures we take now. So ledger accounts are of three types: personal accounts, real accounts, nominal accounts. Which accounts are temporary accounts? Nominal accounts. We close them by transferring their balance to trading account and profit and loss account. So in trial balance, if nominal accounts are removed, then what are the remaining accounts? Personal accounts and real accounts only. So these personal accounts and real accounts we have to show in balance sheet. So the balance accounts, nothing but the leftover accounts, we are showing in balance sheet. Therefore, balance word we are using. So balance means what? The remaining accounts. What are the remaining accounts after preparing trading account and P&L account? Personal accounts and real accounts only. Regarding balance sheet, remember one important point, that is in ledger we prepare three accounts now. Personal account, for example, bills, receivables account. This is a personal account. Similarly, real accounts, for example, machinery account, and nominal accounts, for example, salary account. You know, nominal accounts do not come in balance sheet. So forget about nominal accounts. Observe these two. If any personal account shows a debit balance, means what? After posting all the values, debit total is 50,000, credit total is 40,000. So which side balance carried down we record? Credit side. Now this balance is called debit balance, no? Where it appears? Asset side. So remember, on asset side, what we have to record? If any personal account shows a debit balance, it will be recorded on asset side of the balance sheet. Take another personal account. For example, bills payables account. Throughout the year, whatever bills payable related transactions take place, we post in this account. At the end of the year, we have to balance this account now. How we balance? By writing balance carried down. Where it comes? Debit side. Means what? Credit total is more than the debit total in bills payable account. Now this amount where we should show? In balance sheet, on liability side we have to show. If any personal account shows a credit balance, then on liability side we have to record that. And real accounts. Real accounts means any account which is opened with one asset name. Asset account always shows a debit balance. Means which side balance carried down comes? Credit side balance carried down. Debit total will be more than credit total in case of all real accounts. Then this amount appears on asset side. So real account, if it is a real account, it always shows a debit balance. That balance we have to write on asset side of balance sheet. Be clear with this point. In balance sheet, we record personal accounts and real accounts. Real account always shows a debit balance, and that balance we have to record on asset side of balance sheet. If personal account shows a debit balance, show it as an asset. For example, debtors account, bills receivables account, etc. And if any personal account shows a credit balance like creditors, bills payable, loan from bank, then that amount we should record on the liability side of balance sheet. In balance sheet, liabilities total, asset total should be same, no? Why? One reason is already explained to you. Balance sheet is nothing but a statement which shows the sources and application of capital. How money came, we record under liability side. How this money is utilized, we record under asset side. See this example. Owner brought 20,000 rupees capital into the business, and from bank we have taken 10,000 rupees loan. 5,000 worth goods we purchased from suppliers on credit basis. So total capital 35,000 we got from these sources. Now how this 35,000 is utilized? Out of this 35,000, 5,000 worth machine we purchased. 7,000 we spent on furniture, and the remaining amount is in bank and in the firm. How much amount we kept in the bank? 21,000. And to meet day-to-day expenses, with us we kept 2,000 rupees. So asset side total is also 35,000. This is one reason why asset side and liability side total should be same. For this question there is another reason also. Balance sheet is nothing but an elaboration of accounting equation. What is accounting equation? Capital plus liability is equal to asset. Capital and liability both we are recording on left side. Capital amount is how much? 20,000 rupees. Plus liabilities means what? The loans which we have taken from outsiders. From bank we have taken 10,000, plus from supplier we have taken 5,000. So outside liability is 15,000 rupees. This total should be equivalent to asset side total. 20 plus 15, 35, no? 35,000 is equal 35,000. So why balance sheet two side total should be same? Because balance sheet is prepared based on an accounting equation. Accounting equation says that every transactions we are to record in two sides, debit side and credit side. So the end result is two sides total should be same. Same point in another manner also I'll explain to you. Take one transaction. Salaries paid 10,000 rupees. What is the journal entry for this? Salary account debtor to cash account 10,000, 10,000. Now in ledger, we open salary account, we open cash account. As salary is debited, in salary account debit side we have to post 10,000 rupees. Similarly, as cash is credited, in cash account credit side we have to post this 10,000 rupees. So it is clear that if there is any business transaction, in minimum two accounts we have to post the transaction. And how we have to post? In one account if we debit that amount, in another account we have to credit that amount. All these balance carried on figures we are writing in trial balance. Thus every transaction when you are posting for one time in debit side of one account, second time in credit side of another account, if you total them, then how the debit and credit total should be same. That is the reason why trial balance will tally. And trial balance includes all personal accounts, real accounts, nominal accounts. Now, these nominal accounts may show debit balance or credit balance. Suppose salary paid, that account shows a debit balance. Commission received, that account shows a credit balance. So all these debit and credit balances of nominal accounts we transfer to trading account and profit and loss account. So from trial balance, these nominal accounts we have taken to trading and P&L accounts. If there is any difference between debit nominal accounts and credit nominal accounts, then that difference is nothing but net profit or net loss. If it is net profit, what we are doing? In balance sheet to capital we are adding. If it is a net loss, in balance sheet from capital we are deducting. So if nominal accounts are excluded, then the remaining accounts in trial balance are personal accounts and real accounts. So some personal accounts are showing debit balance, we take them on asset side of balance sheet. Some personal accounts show a credit balance, we show them under liability side of balance sheet. And real accounts always show a debit balance. So on asset side we write that real accounts, and the difference between debit and credit of nominal accounts, that is nothing but net profit and net loss, we are adjusting to capital. Then finally, what rule is applicable for trial balance? Same rule is applicable for balance sheet also. When any transaction is recorded once in debit side of one account and second time in credit side of another account, in balance sheet also the two side total should be same. Therefore, personal accounts which are showing debit balance we are recording on asset side. Personal accounts which are showing credit balance we are recording on liability side. Real accounts which are showing a debit balance we are writing on asset side. And a nominal account debit and credit difference also we are adjusting to capital. Therefore, when you total balance sheet two sides, the total amount should be same.